The prime rate is a crucial component in determining mortgage rates in Canada. It acts as a benchmark for variable lending products, including mortgages, lines of credit, and home equity lines of credit. Changes in the prime rate can significantly influence borrowing costs, shaping interest rates, and impacting the financial decisions of homeowners and potential buyers. Understanding how the prime rate functions, how it is determined, and its effects on various mortgage solutions is essential for making informed choices about your financial situation. So, what exactly is the prime rate? The prime rate is the interest rate that major banks and financial institutions charge their most creditworthy customers. In Canada, the prime rate is closely linked to the Bank of Canada's policy rate, adjusted by a factor of 2.20% since 2015. The central bank's policy rate serves as the benchmark that influences the rates banks set for their prime rate, directly affecting all their variable lending products. The Bank of Canada adjusts its policy rate to balance economic growth, control inflation, and maintain financial stability, which directly impacts the Canadian mortgage market and the broader economy. One of the key reasons for these adjustments is to manage inflation, ensuring it remains within the target range of 1 to 3%. When inflation rises, the Bank of Canada increases the policy rate to discourage borrowing and spending, cooling the economy and reducing upward pressure on prices. Conversely, when inflation is below target or economic growth slows, the bank lowers the rate to stimulate borrowing and spending, supporting financial stability and economic activity. These policy rate changes also affect the value of the Canadian dollar. A higher rate strengthens the currency by attracting foreign investments, while a lower rate weakens it, making Canadian exports more competitive. This is particularly important since the United States is Canada's largest trading partner, and adjustments in the U.S. policy rate by the Federal Reserve can create ripple effects that influence the Bank of Canada's monetary decisions. The prime rate directly affects certain mortgage types, including variable rate mortgages, adjustable rate mortgages, and home equity lines of credit. Each of these mortgage solutions has unique characteristics and responds differently to changes in the prime rate, impacting monthly payments, affordability, and borrowing costs. Variable rate mortgages are directly tied to the prime rate. When the prime rate rises, the interest on a variable rate mortgage increases, leading to higher interest carrying costs on monthly payments. These mortgages often offer lower rates and payments than fixed-rate mortgages during low-interest periods, which can result in substantial savings for borrowers. However, borrowers with variable-rate mortgages must be prepared for fluctuations in interest rates, which can cause unexpected increases in interest-carrying costs. Adjustable-rate mortgages are another type of variable mortgage where both the interest rate and monthly payment adjust with each prime rate fluctuation. These generally offer lower rates than fixed-rate mortgages, making them attractive for borrowers looking to save on monthly payments if the prime rate is expected to decrease. However, rate adjustments tied to the prime rate can cause monthly payments to rise significantly during rate hikes. Unlike variable-rate mortgages, adjustable-rate mortgages won't add to your mortgage balance since the payment adjusts to compensate for rate changes. Home equity lines of credit are also directly linked to the prime rate. Changes in the prime rate immediately impact the interest rate applied to the outstanding balance, causing payments to increase or decrease. HELOCs allow homeowners to borrow against their home equity as needed, but rising rates can make this borrowing facility more expensive. Fixed mortgage rates, on the other hand, are unaffected by the prime rate and are instead based on broader market trends and expectations regarding the Bank of Canada's ability to manage inflation. These rates are influenced by Government of Canada bond yields, particularly the 5-year yields, which are heavily influenced by the 10-year U.S. Treasury bonds. Fixed rates offer stability by locking in an interest rate for the mortgage term, making them ideal during periods of rising rates or economic uncertainty. The choice between fixed and variable rates is significantly influenced by the prime rate. Fixed rates provide stability for risk-averse borrowers, while variable rates offer flexibility and potential savings for those comfortable navigating rate changes. The right choice depends on your financial situation and how you expect the prime rate to move. To manage prime rate fluctuations, it's important to monitor rate trends, consider hybrid mortgages, and work with a mortgage broker to find the best rates and strategies based on current market conditions. Getting pre-approved for a mortgage can also lock in rates and help plan for future home purchases. Looking ahead, the prime rate is expected to stabilize further, depending on factors such as inflation trends, economic growth, and policy shifts by the Bank of Canada. As the Canadian economy continues its recovery, borrowers should prepare for potential rate hikes, primarily due to economic divergence from the United States or the possibility of tariffs becoming a reality. However, those who act now can still take advantage of lower interest rates and favorable mortgage terms if potential monetary tightening is expected. Navigating the impact of the prime rate requires strategic planning. Whether you are buying your first home, refinancing an existing mortgage, or approaching renewal, having a clear mortgage strategy is essential. By understanding how the prime rate affects your mortgage options, you can make smarter decisions that align with your long-term financial goals. Statistics Canada recently reported that the Canadian economy experienced a growth of 0.3% in October. This growth was largely bolstered by the mining, quarrying, and oil and gas extraction sector, which saw a robust increase of 2.4%. This sector's progress was marked by a 3.1% rise in oil and gas extraction, making it the largest contributor to the economic expansion for the month. The October growth follows a 0.2% increase in September, highlighting a positive trend in the economy. Services producing industries grew by 0.1%, marking the fifth consecutive month of increases, while goods producing industries rebounded with a 0.9% rise after 4 months of decline. Manufacturing also showed signs of recovery, with a 0.3% increase in October. This was particularly driven by non-durable goods manufacturing, which helped reverse a pattern of 4 consecutive monthly declines in the sector. CIBC senior economist Andrew Grantham described the October gains as a larger-than-expected stride forward, noting that the results slightly surpassed consensus estimates. However, he warned that early indicators for November suggest a potential stumble, with an estimated 0.1% decline in real GDP for the month. Statistics. Canada's early estimate for November points to decreases in sectors such as mining, quarrying, and oil and gas extraction, as well as transportation and warehousing, and finance and insurance. These declines were partly offset by increases in accommodation and food services, and real estate and rental and leasing. Andrew Grantham further commented that despite monthly volatility, the fourth quarter GDP is tracking below the Bank of Canada's projections and the economy's long-term potential. As a result, he anticipates that the Bank of Canada might reduce its key policy interest rate by a 0.25 percentage point in its January meeting, as opposed to the 0.5 percentage point cuts it implemented in its last 2 meetings. The real estate and rental and leasing sector saw a 0.5% increase, marking its 6th consecutive monthly rise and the largest since January. This growth was driven by increased national home sales, particularly in major markets like Greater Toronto and Greater Vancouver. The sector experienced its most significant monthly activity since April 2022. The construction sector also grew by 0.4% in October, with non-residential building construction being a primary driver. Additionally, wholesale trade posted a 0.5% growth for the second consecutive month, with building material and supplies, especially lumber, plywood, and millwork, being significant contributors. Canadian Chamber of Commerce. Senior economist Andrew DeCapua expressed expectations for GDP growth in the fourth quarter to be close to 2%. He noted that if this momentum persists, it could influence the Bank of Canada's decision in January, potentially slowing the anticipated pace of rate cuts in the new year. DeCapua also highlighted potential challenges ahead, including tariffs, reduced immigration targets, and increased uncertainty, which could impact business outlooks. Despite these concerns, he found it encouraging that the economy ended the year with a solid GDP data point. In a recent report from the Canada Mortgage and Housing Corporation, it was found that Hamilton is experiencing a slowdown in rent increases, and this could be linked to the federal government's cap on study permits for international students. As a result, the demand for rental units, particularly around major educational institutions like Mohawk College and McMaster University, has decreased. The report highlights that the average rent for apartments on the mountain and in West Hamilton, where these institutions are located, saw a slight reduction compared to last year. Citywide, the average rental rate for a two-bedroom apartment rose by only 2.3% year over year, a significant drop from the 13.7% increase observed in October 2023. Anthony Passarelli, a senior analyst at the Canada Mortgage and Housing Corporation, noted that the cap on international student permits has contributed to a noticeable drop in demand for student housing. This was evident as researchers found more last-minute vacancies available in areas that typically filled up quickly in previous years. The vacancy rate around McMaster University surged to 4.1% in October, up from less than 1.5% a year earlier. Similarly, near Mohawk College, the average rent for an apartment fell slightly to $1,446, marking the first decrease in rents for the area in at least 3 years. While the decline in international students is a significant factor, it's not the only one affecting the rental market. The number of rental apartments in Hamilton increased to 45,455 in October, the highest in over 3 years. This influx of new supply has helped raise the city's vacancy rate to 2.4%, up from 2.1% in October 2023. Despite the new units, many are considered high-end and come with a hefty price tag, which has resulted in some landlords offering incentives to attract tenants. However, many renters are still searching for more affordable options, indicating that affordability remains a major issue. The average rent for an apartment in Hamilton increased slightly to $1,531, up just $38 from last October. This modest increase is part of a broader trend of slower rent growth, which could be seen as a positive sign for affordability in the region. The rental market in Hamilton is undergoing changes with the combination of increased supply and reduced demand from international students. While rents are still high, the slower growth rate offers a glimpse of hope for improved affordability in the future.